essentially what we are saying, contrary to many of our competitors and industry experts, is that in 2024, we expect home prices right across the country to increase.
Yes.
Not just in the major markets like Toronto and Vancouver, but right across the country, to a lesser extent in some of the smaller markets, notwithstanding Calgary, which is the real standout star of this report, but we'll get to that in a bit. What I want to ask you to talk to our viewers about is what makes Royal LePage so bullish when the banks are coming out predicting continued slowdowns and declines, not only in prices, but in sales. They're continuing to say that low affordability is going to just keep a lid on prices next year. And we came out guns blazing saying, no, prices are going to go up. Right? Prices are going to go up. Why are you so confident in that, though?
Okay, so let me summarize what's in the outlook, the forecast, which we have done as a company for decades. We are expecting home prices to end 2024, a year from now, in aggregate. When you take all types of properties, all properties across Canada, up 5.5%. That, interestingly, is just a hair below what we would say the long-term norm has been, which is around 6%. So in Canada, home prices over the decades appreciate faster than the cost of living. Why? Because people huddle together. We create in urban living, we create artificial scarcity. You put a pin in the map, people cluster around it, it bids prices up. So you expect home prices to appreciate faster than underlying wages and salaries and the cost of living. And that's not a bad thing, because real estate it sort of vies for number one or number two most important industry in Canada. It's a huge driver of our economy. And it is an incredibly important form of wealth creation for Canadians. About 2/3 of Canadians own their homes, and they are very, very happy with their own with that fact that they're homeowners. The outlook for the country, it's based on a number of things. The first is we anticipate that there will be no change in the policy rate, it's sometimes called the bank rate, from our central bank, the Bank of Canada, through the first half of 2024. We are anticipating a modest change to the bank rate, a decrease in the second half of 2024. So when you're doing this kind of modeling, you have to make some assumptions. Those are key assumptions. We don't think that we need a large decrease in the bank rate to drive a substantial change in behavior among Canadians. Over the past 2 years, and it's been almost 2 years by the time we start to see prices moving up again, this market correction, this post-pandemic market correction, has been substantial. We've seen volumes down across the country about 30%, which would make it the biggest market correction this century, over the last 25 years. Why? Because we had the most outlandish upside or surge in demand for housing, and the number of hands that traded hands during the pandemic in that second half of 20 through to the first quarter of 22, the market went crazy. And when you have overshooting on the top end, you have a correction on the bottom end. We all knew that. Anybody who's been in the business and talking to our top tier across the country, you understand that as well. It's a pendulum swing. So the question is, when do we see things coming back to approaching the norm? And we see that happening in 2024. In fact, we see a pickup without a change in interest rates. And I'm talking about that bank rate now, not necessarily retail mortgage rates. Right. Without a change in the bank rate, we see that actually starting to happen in the first quarter. We see home prices rising by 0.5% in the first quarter, a tiny little bump in prices. Why is that important? because it signals a change in direction. We don't expect much change through December, January, and February. But when we get towards the end of February into March, we believe this elongated 2-year downturn in the real estate market, where the number of transactions have been muted, is reaching a boiling over point. Call it that pent-up demand. And during this period, organic growth in Canada, this is household formation from young people, is still peaking. We're still having peak millennial household formation organically. That's people that were born and raised in Canada. And we have record levels of immigration. And that demand needs to be unleashed somehow. So why wouldn't it be unleashed? Well, one reason would be if people don't have the capacity to buy. But employment is very high. Employment last month was an outstanding month in job creation in Canada. It was 42,000 new jobs. The default rate on mortgages is very, very low. You may catch sometime in the media, they got to write about something that it is anticipated that the default rate will go up. Well, say it goes up 50%. That would mean that it's going from 0.15 or just over 0.1% of the mortgages outstanding in 90 days or more behind on payments to their bank could go up to 0.23. So still the lowest in the world. I mean, we have a really tight mortgage book in this country. So for very low mortgage defaults, very high employment, savings are very high in Canada. Unlike the United States, and I don't know if we'll have time to get into some of the difference between Canada and the United States, but sometimes we mix up, consumers certainly do, the news coming out of America with the situation in Canada. In America, the savings rate peaked and is falling. In Canada, it's continued to stay high and grow. So people are sitting on money, they have jobs, and nobody's losing their houses. So home prices have remained remarkably stable despite a 30% drop in the number of homes trading hands. This demand is building. We're going to see some of it unleashed in the spring with no change in the bank rate. So that's a long-winded way of saying how we landed at 5.5%.
Summing it up. I want to talk about one of your Soperisms. I've worked here for a couple of years and I've heard you come up with a couple of doozies. My favorite, I think, was still during the pandemic when you said the 3 Ps of the pandemic, what Canadians prioritized were Pelotons, puppies, and properties. I think that's going to go down as one of the top 3. But this, the title of this campaign was The Great Adjustment, which was something that you came up with. Tell us what that means. What is the adjustment that you're expecting next year, Phil?
I do like the catchy phrase. You're going to see that in my kickoff presentations through the first few weeks of the year. The Great Adjustment. It's our theme. So what do I mean by the Great Adjustment? I mean we're okay now. It's consumer confidence that's keeping the market down. It's not structural affordability. Yes, there are some people priced out in the market, but not 30%. There are a number of people sitting on the sidelines, great numbers of people, because they don't want to buy a house today they think is going to be less of cheaper tomorrow. That's simply it, especially first-time home buyers. If you're in the market, if you already own a home and you're selling and buying in the same market, it really doesn't matter. Although, again, this doesn't always get through people's minds. Sure. But if you're selling for less than you think your home's worth, you're also buying for less than that home could potentially worth. So selling and buying in the same market is just fine. As a matter of fact, if you're moving up like most buyers do, a down market's a great time to buy. But you all know that. It's the first-time home buyers we need to convince that this is a good time to re-enter the market. Some of them are going to re-enter the market just because they can't stand living with their in-laws another week. But a lot of them need some sign that things are okay. And this is why I talk about the Great Adjustment. we're seen with enthusiasm in equity markets around the world. I think everybody caught on that the American central bank, what we call the Federal Reserve, came out with a fairly bullish and upbeat assessment of containing inflation, and hinted that accommodative monetary policy, which means interest rate cuts, were in the future. Markets took off. It's been a really strong week or so in markets. It's also impacted bond yields and fixed rate mortgage prices. So you can get mortgages in Canada for just a hair over 5% now. Talking about a 5-year fixed mortgage, 5.18. I was looking this morning. It won't be long before that number moves down into the fours. And if you're talking about 4 to 6% mortgages, depending on creditworthiness and the amount of leverage involved in purchasing the house, you're talking about low normal interest rates over the last 30 years. People need to adjust themselves, their confidence, and their thinking that a 4 or 5% mortgage is completely normal, and a 2 to 3% mortgage was something that was employed during an economic crisis and is not normal. And we're going to adjust to it. It will be the great adjustment. I don't anticipate big material changes to the bank rate. If you've got clients that are waiting for, a 150 basis point, 200 basis point cut in the bank rate, like down to 3%, I don't see that happening. Not in 2024, probably not even in the first half of 2025. We are going to ease that bank rate down so that inflation doesn't creep back in, and it's all we need to get the market going. A 25%, 25 basis point decrease, a 1/4% cut in the bank rate would unleash a torrent of joy among potential home buyers across the country. And that's why we see in the second half of 2024, home prices starting to click up again at a healthy rate. Not because interest rates are plummeting, but because people have adjusted. It will be the great adjustment.
So the adjustment is really coming in the form of the attitudes of Canadians, buyers and sellers, and sort of what they'll be willing to accept, or what they'll see as the new normal for their finances.
What's normal, what's healthy.
Right. And we saw that earlier this year too. At the end of 2022, we predicted that home prices would be basically flat over the coming year, with everyone sort of accepting that interest rates could continue to go up. But we were surprised to see quite an influx of activity, and therefore home prices go up just in the beginning of the year. As soon as the Bank of Canada made that first pause, within a couple of months, we saw prices shoot up. So we expect that when we see the reversal of that, we're gonna see that again.
Actually a decline.
Yeah, even if it's only a 1/4 point, we'll see sort of the attitudes of Canadians start to say, well, we better get it now before there's more pressure on the market.
It's a consumer confidence issue. It's not a structural. The fundamentals. Last night I was lying in bed, and I don't know why. The opening line of A Tale of Two Cities, a great Dickens novel, came to me. It starts, it was the best at times, it was the worst at times. It was a time of light, it was a time of darkness. It was the spring of hope, it was the winter of despair. It's kind of what we're into right now, right? We've had the pandemic, which was the darkest of times. And then for the real estate industry, it was the best of times. We've had this correction, which was nasty, a nasty correction. As I bounced around to a few holiday parties this year, I definitely, a lot of gallows humor as we're talking about the 2023 market. Yet at the same time, employment's high. The Canadian economy has done really well through this. Savings are high. Interest rates are going lower and not going higher. It's the best of times. So it's been a topsy-turvy 5 years in the real estate industry. I applaud you for continuing to keep keep the faith and drive your businesses forward. Your results, the top tiers results, really quite astounding given the overall state of the market. So well done, folks. Well done. Yes. And yeah, that's why we essentially are feeling positive.
You took the words out of my mouth. So you have often referred to the Canadian market as a tale of two Canadas, so to speak, a tale of two parts of our country.
Like
so it's no surprise that we're expecting prices to go up in places like Greater Toronto and Greater Vancouver, where we know that demand is super high. It's always going to be the hubs where new Canadians flock to. It's where jobs are healthiest, and where supply is always tight. But we're looking ahead at sort of a tale of three Canadas, if I may. We have to talk about Calgary because that's really the standout of this report. We're expecting the aggregate home price to increase 8%, driven even more so by gains in the condo segment. Calgary's been on a bit of a roller coaster. What makes us so confident? What makes you so confident that Calgary is going to see the gains that we're expecting next year?
Yeah. So in terms of maybe I just summarize what we're outlooking by major cities. So we're seeing Vancouver coming in. This is aggregate between condominiums and detached homes, coming in at 3%, I believe, and then Montreal was at about 5.
Montreal at 5 and Toronto at 6.
And Toronto at 6 above the national average, and Calgary at 8. Ottawa's around the Toronto numbers. Yeah. So the big thing is affordability, of course. You can get 2 of the benchmark Royal LePage homes in Calgary for 1 in Vancouver, and almost 2 in Toronto. So why would that be? When I first came into this job way back in 2002, the ranking of the most expensive cities in the country went Vancouver, Calgary, Toronto, Montreal. Montreal was quite a bit cheaper, quite a bit more affordable. So Calgary was the second most expensive place in the country. It's a twitchy market. In 2014, in the fourth quarter, oil lost 80% of its value. It just $100 to $20 a barrel. And what ensued was a 5-year period of essentially no home price appreciation. In fact, we give back 1 or 2% a year. Condominiums in particular were really hard to move. There was an oversupply of condominiums during that period. And so while Calgary was sitting, and Edmonton was sitting like this, the rest of the country was having affordability issues, right? We're double-digit increases in Vancouver, Toronto, Montreal, Ottawa, Halifax. So Calgary got cheaper and cheaper relatively till we were now sitting, last time I looked, oil was over $70 a barrel. Nice, healthy number, helping the economy. And the Alberta economy continues to diversify, to be ever so slightly less reliant on energy. And so the pandemic happens. And all this technology we've had for sitting around forever that allow us to work remotely, to do things like this Zoom call today, suddenly is necessary to keep the economy moving. And companies and employees wake up to the fact, hey, I don't have to be in the office every single day. I can work quite effectively as a remote or a hybrid employee. And suddenly we see this migration of people from expensive primary cities into more affordable secondary cities. Early this year, I was in St. John, New Brunswick, giving a little talk, and one of the women in the audience got a little teary. I was talking about the influx of people from Southern Ontario into Atlantic Canada and how it had created a boom in the real estate market. And, I asked her why she was upset. And I knew why she was upset, but I wanted to hear her say it. She said, I don't think my kids will ever be able to afford a house. Of course, homes in St. John, New Brunswick are a fraction the cost of what they are in our big cities. But she had a point. Home prices there were rising by double digits, something we just didn't see in Atlantic Canada typically. There had been a reversal of traditional migration patterns. If you go back over the last half century, there's only two consistent gainers by interprovincial migration. This is if you take immigration out of the picture, and that's Toronto and Vancouver. Calgary, Edmonton, Alberta, call it, gets added to the list in the boom bust economy. At peaks, people would flood into Alberta, and then that trend would stop. This got reversed during the pandemic, and Southern Ontario became the donor of Canadians to other parts of the country. So that slowed down, but it hasn't stopped completely. And people are still moving from Toronto to St. Catharines and to Windsor and London and Belleville and Smith Falls. They're moving all over the province, and they're moving to St. John's, Halifax, Bedford, Charlottetown, Montreal. We're seeing people from Southern Ontario for the first time in half a century moving to Quebec, which has caused some Quebec politicians a little heart palpitations.
That's a conversation for another podcast.
Exactly. They don't control interprovincial migration, only immigration. And they are moving to Alberta in large numbers. And I don't see that stopping in the short term. Although, if you're looking at significantly higher price appreciation in a city like Calgary or Edmonton, it doesn't take very many years before that home price advantage starts to evaporate. It's the same thing we see with suburbs versus urban. We've done some great studies in the past about the cost of gasoline. This is fuel costs on and the impact on suburban home prices. And what we found in our research is when gas prices spiked, home prices in the outer suburbs of big cities had to decline slightly relative to the legacy cores of cities to accommodate people's imputed cost of commuting. In other words, what it costs for gas. Now, it'll be interesting to see how our move to electric vehicles will impact that. But I know that we've had the great equalization or the revival of small city, small town Canada in the post-pandemic era. And that's not stopping anytime soon. It's just sort of the violence of the movement has been calmed down some, but it's not disappearing.
And Calgary's really stood out even over these last 6 or 7 months where we've seen prices come down even modestly in some of the major cities. Prices in Calgary have just continued to go up. And they're just
absolutely interesting though. And I know you and I were talking about this relative to one of those nephews who's not really a nephew, a childhood friend of mine. His son and partner wanted to own their own home. They're Calgarians, where I grew up. They moved to Edmonton because Calgary was so unaffordable. So, affordability is in the eye of the beholder. And there's always going to be people in the United States. There's well-documented migration patterns from places like San Francisco, Los Angeles, San Diego, New York, Boston, call it the coastal areas, which are very expensive, into places like Texas, Houston, Austin, Phoenix, Las Vegas, Nevada. So people move to places where there's increased affordability. But one of the trends, just a thought, that I have spoken to the media about in 2023, which I think is pretty significant and it deserves some serious academic study, is it used to be the number one reason people moved was because of household formation. They got married. They left their family's home. That was number one, and it's still number one. change in life circumstance. But the number two was always jobs. People relocated for work. I think housing has become number two. It's served employment. So employment's been pushed down in the list. And the number two reason people relocate, they move within a city or within the country, is because they want cheaper housing. They want to own a home, or they, even if they're renters, lifestyle, they want cheaper housing, which is kind of fascinating. It'll be interesting to see if we have some more evening of rents and home prices through the decade, if that trend sort of slows down. But it's
talk about condos, specifically sure. The investor market. I know that a lot of our top tier agents have investor clients who are heavily invested in real estate. There's some talk, quite a bit of talk in the media, that in the next year or two, as mortgages come up for renewal and cash flow starts to dwindle on a monthly basis, more and more investors are going to be unloading properties. And we know that that has a bigger impact on the condo segment than anything else. Are you concerned that we're going to see an overflow of supply? Can that put downward pressure on prices?
Yeah, it's a good question. So higher mortgage rates, which we've been dealing with now for a year, do put a pressure on some investors' ability to carry properties. And there are investors that have had to or will have to unload assets, sell properties, because they just can't afford the carrying costs. But here's the big but. In our overall healthy economy, we put a lot of upward pressure on rents. And for every investor who needs to sell, there's another investor knocking on the door, waiting to get in because they want to capture the revenue associated with those elevated rents. So I'm not worried at all.